Today's video is sponsored by The Daily Upside. Use the link in the description below to learn more. Michael Burry hasn't said a lot recently about how he's actually investing in 2023. I mean, he's tweeted here and there about cash flow and debt buybacks, but what if I told you I found a much more detailed view of his strategy this year? Well, technically I didn't find it, Investing with Tom sent it to me, but the point is, I got my hands on Burry's investor letters from 2000 and 2001. And before you ask, what the hell does that have to do with his strategy today? Well, Michael Burry recently has been talking a lot about how the current market looks very similar to the mid to late 2000s. So we can actually dive into these letters to get a really clear perspective of what Burry thinks is going to happen in the markets and how he's navigating them. Most people know Michael Burry as the protagonist in Paramount Pictures' The Big Short, which is a movie about the true events that led to the global financial crisis in 2008. Michael Burry, the main character played by Christian Bale, is a fund manager who discovers some severe instabilities in the US housing market before it collapsed and almost destroyed the entire financial system. The movie is called The Big Short because Michael Burry allocated a huge amount of his investment fund's capital to betting against mortgage-backed securities that ultimately crumbled from widespread defaults. But before all of this even happened, Michael Burry was already a very successful value investor, and for years he's been laying out his investment strategy in quarterly letters to clients of his fund, Scion Capital. And there's actually a lot that the average investor can learn from how Michael Burry was investing in 2000 and 2001. During those years, his fund made a return of 68.24%, while the S&P 500 actually declined a total of 18.45%. So Burry's strategy during this time not only allowed him to avoid the prolonged decline that the broader market faced, but also to actually perform extremely well during this difficult period. And more interestingly, Burry actually thinks today's market looks very similar to what it did back then. So before I break down Michael Burry's investment strategy, I want to talk about why Michael Burry thinks that today's market looks similar to the early 2000s. Much like what we saw play out in late 2021, in the year 2000, highly speculative and unprofitable companies saw significant declines in their stock prices, which we now know as the internet bubble. But not a lot of people talk about what happened next. While speculative internet stocks collapsed severely, as should be expected, it wasn't until late 2000, almost a year later, where the rest of the market began to fall, and then in 2001 a recession began, and the broader market actually didn't reach a bottom until 2003. And Burry sees a similar story playing out today. In late 2021, speculative and unprofitable stocks started to crumble, with many of them now down 80% or more, and a few months later the rest of the market began to fall. In a tweet from a few months ago, Burry said that he thinks today's market looks like the mid to late 2000s period, which essentially means he believes that the broader market has further to fall. And this isn't Burry just looking back in hindsight, because he actually had the same contention before this had happened the previous time in 2001. He wrote that his preference is to buy long-term franchises at a substantial discount to growing intrinsic value, or in other words, to buy high-quality businesses. But that as of early 2001, high-quality stocks still had high valuations based on overly rosy future expectations, and that they would be prone to further revisions as expectations were reined in. And he was exactly right. From that point forward, the S&P 500 fell another 25% over the following 2 years. Today, the biggest names in the S&P 500 still have prices that arguably reflect very rosy future expectations, and if there was to be a recession, say at the end of this year or throughout this year, similar to the recession that came after the tech bubble in 2001, then it wouldn't be surprising to see large companies have their expectations reined in, similar to the large cap businesses in 2001, and that maybe they have more to fall. So how did Burry make almost 70% over 2 years while the rest of the market was declining? Well, he certainly didn't do it by buying expensive large cap companies that still had a ways to fall. Instead, he was looking for undervalued, often very small and illiquid securities. These are groups of stocks that fall under the traditional definition of value. And it looks like this group of stocks are in a similarly good position today as well. Unlike large caps, which prior to 2022 have just been going up at massive rates, traditional value stocks haven't seen that same run up. Although in the last year, in 2022, as the market has collapsed, those value stocks have also experienced the downside. And the result of that is there is now a very large spread between the valuation of value or cheap stocks and the rest of the market. I spoke about Joel Greenblatt's research on this in a recent video. His research showed that the US market is still around the 22nd percentile towards expensive, while value stocks are near the 90th percentile towards cheap. And that research supports Michael Burry's contention that, similar to the early early 2000s, we may be about to see value stocks do far better than the broader market. Again, in a tweet from a few months ago, Burry said, free cash flow totally on sale, better businesses still had a way to fall, value was about to take off for years despite more crash on the way. Just before I break down Michael Burry's investment strategy for 2023, I want to talk about the sponsor of today's video, the Daily Upside. There is a lot of noise in the financial media landscape, and it's often really difficult to sort through the enormous amount of disingenuous headlines and fear-inducing tactics to find real, reliable sources of information. But there is a better way, and today I want to share a source that has quickly become a morning ritual of mine, reading the Daily Upside. The Daily Upside is a completely free, curated morning financial brief, followed by more detailed stories that are shaping the business world. It's informative and witty and goes far behind the headlines to provide real substance of some of the most important news of the day. There's coverage of corporate news, the economy, policy changes, and investing news, all coming from a team of financial professionals. Personally, I love to keep up to date with business news, and just a couple of days ago, the Daily Upside had a really interesting article about some of the price changes being pushed through by Amazon. Whether you're a financial professional or someone who just wants to get a jump start on what news is moving the markets, the Daily Upside is a perfect solution. It is completely free if you want to sign up, and every morning they send you one information-filled email brief. And on someone who needs to stay on top of economic and business news to create videos like this, I cannot recommend it enough. Join over 850,000 people who trust the Daily Upside and sign up via the link in the description below. So given that Burry sees today's market very similarly to the early 2000s, it seems appropriate to learn how Burry was investing in the early 2000s. And while I've mostly avoided learning about Michael Burry's investment strategy, which more recently has come to include a lot of macroeconomic predictions, his strategy in the early 2000s is very much classic value investing that is very likely based on the teachings of Benjamin Graham. And since we have access to his quarterly fund letters, we can see exactly how he was investing back then. The biggest common thread throughout the 8 or so letters that he wrote between 2000 and 2002 is the difference between volatility and risk. Burry operates very differently to the vast sea of average performing institutional investors, and one of the main reasons he's able to outperform them is because unlike them, he doesn't consider volatility a risk in investing. In one of his letters he writes, by and large, the wealthiest of the wealthy and their representatives have accepted that most managers are average, and the better ones are able to achieve average results while exhibiting below average volatility. By this logic, however, a dollar selling for 50 cents one day, 60 cents the next day, and 40 cents the next day somehow becomes worth less than a dollar for selling 50 cents on all 3 days. Of course, to any rational human, this is absolutely ridiculous. The value of a business doesn't change based on the changes in what investors are willing to pay for it. And Burry demonstrated this idea in Q4 of 2021 when the September 11 terrorist attacks drove some stocks to absurdly low prices. One of his positions fell to a price that was 3/4 of the free cash flow it produced in the last 12 months. Burry bought more of this stock during this time, and in less than a month, it had 3x'd from the value that it had fallen to during September. And the next month, in December, it was acquired for 7 times its September price. And this is a fantastic demonstration of what most fund managers get wrong. This stock in Burry's portfolio absolutely increased the volatility of his portfolio, but it didn't increase the risk. Whereas most fund managers would have ignored this investment simply because of the volatility, thinking that the volatility made it a bad investment, even though objectively you could have looked at the price relative to the cash flows and the business behind it, and it made absolutely no sense to not invest in that company. Burry also gives a number of insights into how he structured his portfolio back in the 2000s. He ran a relatively concentrated portfolio of 15 to 25 stocks or less, noting in one letter that diversification doesn't require more than 15 or more stocks if done correctly. Burry says that he structures his portfolio to protect against a wide variety of unforeseen circumstances. And in his mind, the best way to do this is to minimize correlation between stocks in the portfolio, such as investing in different industries. Burry's actual investment process at its core is relatively simple. He's trying to find $1 with enough volatility that it will sell for 40 cents. He states that most of the time, $1 sells for $1.10 or more in the market, especially if it consistently does so. Fund managers that are trying to avoid volatility often reward stocks that have less volatility by paying more than they're worth. At the same time, volatile stocks often go on sale because fund managers are simply avoiding them because they're volatile. In the early 2000s, Burry was looking for undervalued, smaller, illiquid stocks, which are companies whose stocks are traded so infrequently that a lot of the time they are mispriced by the market. These types of businesses that he was looking at in the early 2000s are often not the best quality businesses, but are average or slightly above average businesses. But that's not really the point here. The point is that you can find value in really any type of business, whether it's small, medium, large cap, whether it's a liquid stock that's traded frequently or it's illiquid. A point that Burry makes a lot throughout these letters is that you should just look for where value can be found, wherever that is. For example, after this period, after the broader market had continued to fall through to 2003, high quality businesses with good management teams and deep competitive advantages actually became a lot more attractive than they were just a few years ago. And maybe even more importantly, on an individual basis, there are great investment opportunities regardless of where most of the great investment opportunities are. So even though value may be very cheap relative to other parts of the market, sure, that's value is where you're going to find, or traditional value is where you're going to find most of the great opportunities, but that doesn't mean that there are zero opportunities in other areas of the market. So on an individual basis, which is how you should be assessing investments, you can find them really anywhere. But regardless of whether you're looking at high cash flow yield companies with limited growth prospects or companies with durable moats and the ability to reinvest capital at a high rate, Burry says it's critical to use conservative projections when looking into the future. The biggest mistake you can make in valuation is expecting that the great performance of a business in the recent past is going to continue for a very long time into the future. If a component of the valuation is projecting growth into the future, you really need to understand the space that that business is growing into and the likelihood that those additional cash flows actually come true. And adding a margin of safety is a great way to add additional protection. Lastly, Burry gives some advice on when to sell your investments. He notes that excess returns he's likely to earn will come from buying stocks absurdly cheap rather than selling them at dearly prices. Or in other words, he's never been good at timing the market, buying the bottom and selling the top, but rather recognizing that if he's buying undervalued business consistently, then the market over time will reward him. His sole focus is to find the best places to allocate capital. If he has cash in the portfolio, which he often keeps a little bit of around for opportunities, then he will allocate that first. But then ultimately, it's just a matter of looking at the available opportunities in front of him and putting money in the best opportunities. If you want me to cover more of Burry's letters in future videos, then make sure you let me know by leaving a comment down below. And of course, hit subscribe if you haven't already and you're enjoying the content here. But with that said, hope you guys have a great day. I'll see you in the next one.